Welcome back to Switzer on Australia's Business Channel. My next guest is the Managing Director of Centuria Property Funds, I should say, an AS-listed property fund manager. He is Jason Huljich, and he's here to give us his outlook for the commercial property market and explain the different markets available to investors, and to also tell us where he sees value and how he is investing at the moment. Jason, welcome to the program.
Thanks, Marty.
First question, so tell us about Centuria. You've been on the show before, but for people that don't know, talk us through what you guys do.
Yeah, look, as you see, we're an ASX-listed fund manager. We have about $2 billion of assets under management in two broad divisions. One's financial services, so we have a friendly society investment bonds, we have insurance, we have mortgages, and then our main part of the business is our property fund. So we buy assets all around Australia, and we have a few thousand investors that invest with us through our unlisted property funds, where they receive a return coming off the income from those properties, and then we manage the assets trying to add value so they get a capital gain as well.
Okay. So you've been in the space for a number of years, and you are an expert in I guess, the commercial property market. Talk us through what's happening in the space at the moment.
Look, it's very interesting times in the commercial property market. It's very strange. You've got a huge weight of money chasing assets. So you can't get yield from many asset classes at the moment. Property is one of the few that you can. So you've got huge demand from...
We're talking yield, we're talking yield like a dividend,
that's right.
Income.
Exactly. So you've got huge demand from onshore, so from our large super funds, the REITs, which are the listed property trusts, plus private investors, and then offshore from Asian, European and American investors. So you've got huge demand, but then your property fundamentals are challenging. So, leasing's tough across the board. So if you look at Sydney...
There's a shortage of... supply?
Yeah, well, there is. Well, it depends on your market. Sydney and Melbourne are actually, they're holding up reasonably well. It's still difficult to lease. Vacancy rates have been edging up across all the major markets over the last 18 months.
Does that mean businesses aren't moving?
That's right,
or
not expanding.
Not growing?
That's right, and if you look at particular markets like Brisbane and Perth had a huge exposure to mining and energy, where there's been huge cutbacks in space, their vacancy levels have been increasing dramatically. And in those two particular markets, you've still got a lot of buildings that are being built, halfway being built, still to come on over the next couple of years. So even though, for example, Brisbane's got a record vacancy level, they've still got a lot more buildings and space coming on, so their vacancy level won't peak for another 2 years. So it really depends on the market.
It feels like that in the Sydney CBD as well. There seems to be a lot of buildings going up at the moment.
Sydney hasn't had a lot to date. Barangaroo, which is obviously a huge project.
It's a land lease.
Yeah, that comes on in a couple of years' time, the first tower. So there will be more office space coming to the market. Look, we're reasonably bullish on Sydney. We think that will take up that space reasonably well. And we're also seeing a lot of office buildings being taken out of the market to be changed into residential properties as well. So with that taking out, even with some new space coming on, we don't think it's going to have a huge strain on the Sydney market.
Yeah. And so you spoke about Perth. So from what you're seeing and the people you're speaking to, is it evident that there is a slowdown in the Western Australian economy?
If you look at Perth, the total stock of commercial office space, about 50% of it is leased to mining and energy-related companies, right? So it's a huge percentage. You compare that at Brisbane at 25% and Sydney at about 10%. So as soon as that slowed down, and the big groups of BHP and Rios and so forth have been pulling back space, their vacancy levels have really shot up. So it is a difficult property market in those sectors.
And then what about so there's the office market, which is businesses renting commercial office space. Sure. There's the retail market, and there's also the industrial market. Right. What's happening in retail and industrial? So retail shopping centres.
That's right. So retail shopping centres. So you have a broad range of shopping centres. You have anything from the regional, which is the very large Westfield style centres. Yep. And those yields are historically very, very low. For some of the best centres in the country, they're trading at low 5% return, so 5.25% return.
You invest your money there, you get 5%.
That's right. If you bought one of those large shopping centres, they go all the way through to sub-regional and then the neighbourhood centres, which is your traditional Woolies or Coles and a few specialties. So the range in yields is sort of 5 to 10%. So there's a huge spectrum. So the regionals are pumping along quite well. The sub-regionals are struggling a little bit. They're caught in the middle. Anything that has a lot of fashion, where the internet's really
it's being
hurting it. Also after the budget, that's sort of the sentiment's really changed a bit. So what we sort of like is we like the non-discretionary. So we like the food and the service-based centres. And that's where we're looking to buy on the retail side at the moment. Industrial's been flavour of the month actually for couple of years.
Yeah.
And
what's an example of industrial?
Industrial is a large shed, leased to
Coles or Woolworths or something.
Yeah, exactly. One of their distribution centres, for example.
Yeah.
And with industrial, you usually have longer leases, so the lease is usually 5, 10, 15 years. And when there's been some, struggles in the office market, a lot of investors have gone to industrial for more stable returns.
Yep.
And traditionally, industrial's provided higher returns, but because there's a lot of money that's been pouring in over the last 2 years, these returns are starting to drop and the prices have gone up. So it's looking quite expensive, we think.
So if I'm a self-managed super fund trustee, I need to get some exposure to property.
Sure.
I look at all the different ways I can invest in commercial real estate. What sort of returns can I expect on average in a range from the 3 different markets?
Yeah, sure. Look, if you're going directly into these assets, if you're looking at commercial office space, probably 6 to 8% if you're buying something in the CBD, let's say.
And that could be listed or unlisted. You can get exposure to that.
Yeah, if you look at listed and unlisted, so the 2 main, other than going direct, like if you don't have $50 million to buy a building in the city, the 2 main reasons, you go through the listed, through the REITs, or you go through an unlisted funds like some of our funds. So with the listed guys, if you're going into one of the large listed groups, so the Westfields, the Stocklands, the Mirvacs and so forth, they're averaging around 5.5% return. Okay? They've got very high quality buildings. They're well diversified across the country. You've got scale. And also you've got great liquidity. It's like a share, you can sell it after 3 days. So they need
to pay less because there's less risk.
Exactly. With the unlisted funds, you're probably buying secondary, probably buying $50 to $100 million assets, still well located, but not the largest assets in the CBD. Most unlisted funds are showing about an 8% return. So there's quite a differential there. They both have their pros and cons. So with listed, you've got the liquidity, you've got the scale, but also listed...
You get less return for that.
That's right, but also listed has very high correlation to equity. So if you're trying to diversify your portfolio, the listed REITs do behave like equities. If you go to unlisted, you don't have the liquidity, so you're in a fixed term for a period of time, maybe 5 years. You have the higher return, but it's a good diversifier. So when you're allocating your portfolio, unlisted property, their returns do behave differently to equity. So it's a nice diversifier for your portfolio.
So in terms of what you would get out of office, you're saying about 5 to 8.
That's right.
Returns?
5 to 8, depending if you're listed or unlisted.
And then for retail?
Retail.
Like a Westfield, for example?
So look, the Westfield, they're trading about 4.5%, 5%. And then if you go into a unlisted fund with a neighbourhood shopping centre in it, you're probably getting around 8%.
Okay. And then industrial, is it a similar sort of...
industrial's similar. Industrial's probably 7.5%, 8% as well.
What sort of impact are you seeing the Chinese having on the commercial property market?
It's all offshore investors really. It's not just the Chinese. You're getting, we're seeing Malaysians, we're seeing Singaporean, Hong Kong. We're getting a lot of those Asian investors coming down, as well as European and US. But definitely the Asian investors getting all the press at the moment. They've been very aggressive into residential development. So they've been in Melbourne for a number of years, buying up sites and developing down there. And either selling the stock into Australia, but also up into Asia. And then over the last 18 months in Sydney, they've been very aggressive, buying a lot of sites and paying what we think is big prices for them. And then what's happened over the last 6 months, we've seen them coming in and buying commercial office buildings in the CBD that might be able to be converted or knocked down even in the medium to longer term and turned into residential apartments. And we've seen groups like Far East come in from Asia and buy a number of properties and pay very strong prices at 25-30% above book value to get access to the Sydney market. And a big reason is, if they're investing into buildings up in Asia, let's say on the commercial side, they might be getting 2.5 to 3.5%. They can come into Sydney and get buildings at 6-7%. So there's a huge differential there on income.
Very quickly before we go, where are you seeing value right now?
We still like the secondary side of the market, so we like $50 to $100 million lot size. Bit small for the institutions and the offshore groups, but big for the privates. We like Melbourne and Sydney. We like commercial offices, and we like non-discretionary retail as well.
If people want to get some more information, they could go to...
our website, centuria.com.au, or 1300 Centuria is our phone number.
Thanks for your time, Jason.
Thanks, Marty.